There is currently £1.8 trillion sat in savings accounts across the UK. 280 billion of that sat in cash ISAs. Not only this, but there's 30 billion being added every year. So it's clear the cash ISA is clearly the most popular savings and investment vehicle in the UK. But should it be? If you're new here, I'm Nick. I'm former investment analyst turned YouTuber, talking all things investing, personal finance and self-development. And in this video, we'll explore why so much cash is being held in cash ISAs, are they being used in the right way, and what other alternatives do people have? It is thought people have on average 69% of their wealth held in cash, comforted by that perceived safety of cash, reluctant to invest, equating it to gambling their hard-earned savings. You know that if you put £100 in 10 years' time, you're still going to have that £100 plus whatever interest you've earned on that period. It's that guaranteed of you're still going to have at least that amount in that savings account compared to an investing account where obviously that value can go up and down. The problem here being is how much of that purchasing power has been lost in that period. This chart here shows the purchasing power of the British pound from the 13th century until now. You might have the same amount of currency, but it buys a lot less over time. It's that keeping up with inflation and asset inflation over time that is eroding that purchasing power of that currency. This chart here shows the split of ISA account subscriptions over the past 15 years. And you can see the cash ISA is still clearly the most popular investment. But when we look at the actual market values of these accounts now, you can see how much more that stocks and shares have grown over that period. We know that's been the superior investment, especially if you look over, those past 15 years. The worst part of this is that over the past decade, we've seen a period of ultra low interest rates. People are parking their cash, getting 0.5, less than 1% in terms of a savings rate, while at the same time, the stock market is being put in all-time highs. This is how much £1,000 invested 10 years ago would have grown sat in a cash ISA. Now, this is how much £1,000 would have grown investing in a global stock index invested 10 years ago. We can also compare the UK to other countries as well, which shows it has the lowest percentage of assets under management in the EU. Now, you're probably thinking so far that I'm not a big fan of these cash ISAs, and that's very far from the truth. They do have their purpose, and that's what I want to explore now. So when you think about the purpose of using a vehicle like this is you want that security, right? You want that cash. And what that's useful for is if you've got, say, a short-term purchase coming out, say that money's been used for a deposit for a house. Now we've got to talk about time horizon, right? So, are we looking to do that in the next, say, 6 to 12 months? Well, in that case, then clearly holding that amount as cash is clearly a good idea. If obviously we've got a bit of a longer time horizon, if we're talking, 2, 3, 4 plus years, then obviously like we've talked about in previous videos, time in the market when you're investing is your friend. So the longer your time horizon, the less risk you're taking by investing in the stock market and the more chance you're going to have to grow that money over time. But let's go back to that first example about if you've got a short time horizon in the next 6 to 12 months. Remember, there's still a cap of how much you can invest into a cash ISA of £20,000 per tax year. So you're probably falling into two camps. Either you've built up a decent investment portfolio from investing and you can transfer a stocks and shares ISA into a cash ISA, and that doesn't need to come out of the wrapper. And from that perspective, that's the best way to do it in theory, right? So you grow in the superior investment vehicle over a long period of time. When you come close to making that purchase, you want to secure that money essentially, so you're moving more of it towards cash. That's absolutely fine and a really, really good example. But if you've either come into some money or you're wanting to then put that money into cash because you're now going to have enough, or then you can only put 20k in. So then how long is that going to take you to get to your deposit, right? Because it's very unlikely you're going to be using just 20k for a house deposit. You're going to need a lot more than that. So then say you're able to save 20k per year and you want to put that into a cash savings. Well, then say your deposit's going to be 50k. Well, then it's going to take you 2.5 years to get there. Okay, now we'll talk about time horizon. We're going back to that other point about, okay, now we've got a longer time horizon. So it kind of depends on where you're coming from, what you want to use it for. The other thing that can be useful to look at is premium bonds. So similar to that example of where, we've built up an investment portfolio, we've had some good growth, and then we want to secure that profit essentially, so move it towards cash. Well, in premium bonds, you can put up to £50,000 per year. It's backed by the government. There's no guarantee of return, but the rate on average is similar to what you would get in a savings account, and they're still tax-free. We also need to touch on emergency funds. So it's that money that you're putting away for that emergency later down the line. Say you've got 6 months of your expenses parked away in cash. Well, then a cash ISA is clearly a very suitable product for that. But once you've saved that, is there any point in saving any more cash than that? Are we worth then now utilizing our stocks and shares ISA allowance and putting that into the stock market? Remember as well that you do have a personal savings allowance, and this changes depending on your tax band. Basic rate taxpayers have £1,000, higher rate have £500, and then it goes to zero for additional rate taxpayers. So if you're a basic rate taxpayer and you've got £1,000 of a personal savings allowance and you're getting, say, on average 5%, well, then you need £20,000 invested to then have 5%, which is going to be your 1,000. You need to have more than that essentially to make it worthwhile putting into an ISA. So it's important to look at the different rates that you might get. Some savings accounts, you might get a slightly higher percentage holding it outside of an ISA than you will holding it in an ISA. So it's worth having a look. So like most things in finance, it's about having that balance, having that security in cash so you've got some emergency funds parked away, but having the majority of your wealth growing over time in the stock market, getting those superior returns. I'll leave you with two definitions, which I love. The first one is the definition of investing. It's a sacrifice of consumption today in the hope of greater consumption tomorrow. Now let's contrast that with the definition of savings. The sacrifice of greater consumption in the future for the certainty of consumption today. Thanks for watching, guys. I'll catch you in the next one.